All right, so let's get into our next family of rules. So we've got the follow-through day stuff down and everything related to it. So this is on page 48. So we have a lot of rules based on the 21-day moving average, and you probably haven't heard Bill talk about the 21-day much. It's something that I started using years ago. I studied a whole bunch of different moving averages, a 19, a 33, I studied everything, and I found that 21 was what really worked best for our system. But I kind of kept it a secret. Well, I kept it a secret because Bill's not a fan of people tweaking his system. And so I was always using it. Then one day, he was switching offices, or I was in his office for those years, and he had a whole bunch of boxes from one of his prior offices that they were going to put out in storage. And I said, well, I want to look through all that cool stuff. And there was a lot of great old notes and things. I learned a lot from it. And there was this one checklist that he had for his portfolio managers back before I was even born, where he said you had a follow-through day, and all these other questions that the PMs would have to answer before they could trade. And one of them was, is the Dow above or below its 21-day moving average? So I'm like, great, the secret's out. I showed him, I'm like, hey, look, you have this, and I've been studying this. And he's like, yeah, that makes a lot of sense. And we went through it. He still doesn't use it. So he used it in the 60s. I use it now. Charles uses it. The way I kind of stumbled on it is I was doing a post-analysis and found that when the market was above the 21-day moving average and trending above it, that's when I was making money. And when we were below it, that's when I was getting killed. If you want to test it out, do a little post-analysis at home and look at where you're making your money, and then look at what the NASDAQ was doing. It was probably in a time when it was above the 21-day. So that's how we came up with this 21-day. There are a lot of rules associated with it, so let's go through each one. So the B3, the low above the 21-day moving average, we're going to buy on an upper flat day, so that means the bar is going to be blue, when the intraday low is at or above the 21-day moving average. So that's pretty simple. So as long as that low is above it and it's up, we're going to buy. Now, trending above the 21-day moving average, so after B3 signal has triggered, buy on the 5th consecutive day that the low is at or above the 21-day moving average. So it's showing that it's trending above it. The B4 signal is only triggered when the index closes up or flat for the day, just like our B3. If the index closes down on the 5th day from the B3, then we're going to wait for an up day to trigger the B4. So the concept there was, we wanted all of our rules to be in line with how Bill traded. We weren't trying to come up with our own system. We were trying to come up with rules that would go along with how Bill traded and how he would buy and sell in the market. And he doesn't typically buy or increase his exposure on down days in the market. So we needed to be in line with what Bill does. That's why we hold off and we don't buy on the weakness. We're waiting for it to actually be up. So that's trending. So once you're above the 21-day moving average, you act. When you're above it for 5 days, you act. Now, living above the 21-day. After the B3 signal is triggered, we're going to buy on the 10th day and every 5th consecutive day after that. So the 15th, 20th, 25th, 30th, 35th, and so on, that the low is at or above the 21-day moving average. The B5 signal is only triggered when the index closes up or flat for the day. Same thing as up here. If the index closes down on the 10th, 15th, 20th day from the B3, we're going to wait for the next day to trigger that B5. So the concept with these is, first you're above the 21-day moving average, we're going to buy. Then you're starting to trend above it for 5 days, we're going to buy some more. Then you're really living above that 21-day moving average, and every 5th day you're going to buy more. Now, most of the time you don't need this buy signal. But sometimes you could be getting distribution in the market, like we've had a lot of high days of distribution. But if it's not hitting the market, we wanted to have something that was going to offset that to balance it out. You have a question?
Yes. These B3 before B5, are these after B1 or is separate?
Good question. Look at each one of these sets of rules as kind of a family in itself. And then when you put it all together, it's going to make sense. So if it's above the 21-day moving average and the low is above it and you're up on the day, it's a B3, regardless of a follow-through day or not. But you're going to see how that comes together a little bit later. I don't want to get ahead of ourselves, but good question. No, volume is not a requirement. This is a price action only. So you could have no volume, you can have a ton of volume. It's a price only. Yes, so far. Yeah, so far.
So if you don't actually have E5 until, say, day 16, Right? Is it 5 reasons from that?
You would go 15, 20, 25, even if you have some red days in there. Good question. Yeah. No. With the system as we're going to teach it today, we're not doing margin. Now, the reality is, how many people here trade on margin? Right. Okay, so you're going to see throughout the day a power trend that we're going to talk about later. There's a logical place where you'd be using margin. But we didn't want to teach a system that's a little bit complicated and use margin in there. We talked about toying with the system and using margin as well as using some shorting. And you could really blow out the returns that Charles showed this morning because we all use margin. So with margin, we did some numbers and it's crazy. But when you're teaching stuff, some people have been trading for 10, 20, 30 years here, and some people have been trading maybe for a year, and it became a tough thing to decide whether to teach it or not. I think if you've been trading for a while and you're successful and you have the ability to know when you're wrong, trading on margin is what we do. But until you get to that point, you'll find it's like your best friend and your worst enemy. Yeah. Yeah, I'm sorry I didn't mention it. It's exponential. The only moving average we use that's exponential is the 21-day. We use simple for everything else. Exponential, it's just an option within MarketSmith. We added it in there just to be able to follow this system, and it's just a little tighter. That's all. I think there was another question. Yes, sir.
Mike, is there any, all the workshops that I've attended, the margin question is asked, but is there any rules or guides on how to learn how to use margin?
Not that we teach, because we're all different when we use margin. As a whole animal in itself, sometimes we use margin really well, sometimes we don't. And the thing is, what I would say about margin is if you haven't used margin, don't go from trading cash account, which is 100% invested, to 200%, which is full margin in any 1 year. You try 10% margin for a while, for maybe 3-4 months, see how you deal with that volatility, then maybe do another 10%. And you're just going to make the money faster when it's there to be made and lose it faster in bad conditions. And that's the reality. And you have to be able to stomach those moves. And it becomes a personal thing if you're comfortable with it or not. I would say don't use margin if you're down for the year ever, because you can make a bad year really bad. I've done that. But when we're in a power trend that we're going to talk about later, that's the time that you would want to be using margin. I'll try to point it out as we go. All right, so let's get into the sell side of this. A break below the 21-day moving average. We give it a little bit of a buffer. This is our sell signal 5. Sell if the index closes 0.2% or greater below the 21-day moving average. We found that with a 21-day, you could get a lot of false signals right as the close was below it. And so we played with this number a lot, and we wanted to find the best number that told you that you bought because your low was above the 21-day and you're up. When should you sell? And 0.2% or more below is the key point. Sell signal 6 is our overdue break below the 21-day moving average. So we're going to sell if the index closes 0.2% or greater below the 21-day moving average after 30 days have passed since the last B3 without triggering an S5. So what does that mean? It's basically saying that 30 days have passed and we haven't had an S5. So we haven't broken the 21-day moving average for 30 days and closed 0.2% below it. We're going to sell with an S5 and an S6 because we had all of those B5s that were getting invested in the market deeper. So this is balancing against that. So you'll see with our rules that they all go in families, and we have the buy side and the sell side. So with the follow-through days, we have the B1s and the B2s, and with the S1s and the S2s, the 21-day moving average, it goes the same way. And just like we had the trending above and the living above, we have a trending below and a living below. And it's the same concept, but we'll read through it. So an S7, after an S5 has triggered, we're going to sell on the 5th consecutive day that the high is below the 21-day moving average. So it's really stuck underneath there. The S7 signal is only triggered when the index closes down for the day. So if you had a reversal day, we're going to wait until you actually see some weakness before we act on it. If the index closes up on the 5th day from the S5, then we're going to wait for the next down day to trigger the S7. The same thing that Bill doesn't like to buy on down days. He's not really going to be selling if that day is back up. So that's why we have that rule. S8 is the same thing. but all it's saying is the 5th, 20th, and 25th. So the same thing as we had with the living above, but let's read through it. After the S5 signal is triggered, sell on the 10th day and every 5th consecutive day after that, 15th, 20th, 25th, 30th, 35th, and so on, that the high is below the 21 day. If it pierces back above it, it's not the same. So the S8 signal is only triggered when the index closes down for the day. If the index closes up on the 10th, 15th, and so on from the S5, and wait for the next day to trigger. It's a lot of words on the chart. It's going to make a lot more sense. Page 48, we put this in here to make it a little bit easier to comprehend. And when you see the chart, you'll understand. So the B signals, the B3, 4, and 5, get reset with an S5. So a B3 is above the 21 day, then this is above it for 5 days, and this is 10, 15, and so on. That gets reset with S5. So once you have a B3 or B4, you can't have another one until there's another S5. So you can have another B5 because you're going to have a B5 every 5 days, but you're not going to have a B3 or a B4. The same thing is over here for the sell side. Once you have an S5, S6, or an S7, you can't have another one until it's reset by the B3. So let's look at some charts so this will make more sense. This is on page 49. So don't worry about the distribution days or follow-through days. Just focus on the 21-day moving average. So the red line here is your 50-day moving average. The black line is your 200-day moving average. Your green line is your 21-day exponential moving average. So on this day, we don't buy because we're waiting for our low to be above it. We just found that we wanted to cut down on the noise. So we tested it out with just buying when your close was above it. And that worked very well. But by waiting for the low to be above it to cut down on a lot of the false signals, it gets you in a little bit later. It's a balancing act when you write a rule. Sometimes you get hit a little bit. So we'd rather wait for that low to be above your 21 day. And so we're going to act on that as a B3. So now you break below it. Now again, we have a threshold. This one isn't quite 0.2% below it. So we're waiting for it to be 0.2%. So you'd have to right-click on your mouse in MarketSmith, and it'll show you those percentages. Here you have an S5. Now it's reset everything. Because we've had an S5, we can have another B3, which we have right there. We don't act on this day because our low isn't above it. Our low is above it right there. Then we get a B4 and a B5. So we've been above it for 5 days. So day 1, 2, 3, 4, 5. Our 5th day, and we close up for the day, and our low has been above that 21 day. We're starting to trend above, so we're buying on that. Day 6, 7, 8, 9, 10. On our 10th day, our low has been above it, but we're not up on the day, so we're waiting. Then on this day, it's up on the day, and we've still been able to maintain our low above it, so that's a B5. So does this make sense so far? Then you have all of these additional B5s on here. And this is just saying that these are grayed out. You don't really need them, but we wanted to have something in there that was saying that if you're getting a bunch of distribution and it's not pushing you out of the market, it's saying that distribution just isn't working right then. And sometimes distribution doesn't really work. Other times it works beautifully and gets you out exactly right. So here, these signals are there in case you need them. A lot of the charts today, after we get through the morning session, there are a lot of signals that are being triggered that we don't even gray out. But if it's not needed, we're not going to mark it because we don't want to have too much noise. So we're living above it.
So Mike, if you're using margin, would those potentially be points where we would act?
Not necessarily. When we use margin, one, so you're up on the year, your stocks are working well. And lots of times it's you have 5, 6 stocks, and there's another stock that breaks out that you want to buy, and you look at your holdings and you go, well, I don't want to sell anything, so I'm going to buy a little bit more. Lots of times it's just that the market is in a forgiving mood, and so this is very forgiving, but I wouldn't say, okay, it's another buy signal, I'm going to buy more. It's more, what's the merchandise out there? During this time, you could just be in the wrong stocks, and all your stocks could be coming down. So our system really gives you a target of where you should be if everything is working right. But you could be 100% invested here according to the system, but your stocks are just out of favor. Maybe you're in a group that people are rotating out of. If your stocks are getting hit, you're going to be underinvested. And we'll talk about that at the end. Okay, so now, let's see. We have a few things going on here. So let's go through these. We've been above this 21-day for more than 30 days. So we've had the overdue break. That's why we have our first S6. So you can see that we had all those B5s that were going along there. When this eventually broke, lots of times it'll just do this. It'll just stop going up for a while, and then it regains its momentum. But you want to take a little bit of extra action as it relates to the 21 days. So that's why we have the overdue break, because you've had 30 days that you haven't had an S5. So now we're up here, and we're going to buy because our low is above it, and we're up on the day. We get a B4 and a B5. Now we've been 10 days above it. So can you tell me anything on that day that would tell you that you should be selling? The answer is no. Unless someone could come up with everything looks great there. But that's why we have these rules, that our expectation is that you're going to continue to move higher. But it doesn't, so we need to back away. And it doesn't mean you throw in the towel and sell everything. You just react with one sell signal. So you're not going to have the S6 because you haven't been trending above it for a long time to get a whole bunch of B5s. You're just going to sell some and react because you don't know how much lower it can go. Many times the market will just look like it's going to continue to move higher or lower, and it breaks that expectation, and you just have to be flexible, because at the end of this day it looks like you're going to just continue on like over here. But whatever reason, maybe a news event, it needed to come down, and then we get an S7 here. This is our first S7 because our high has been underneath that 21 day. So we've got 1, 2, 3, 4, 5. So that's our S7. And then we have our B4, it's grayed out, and then the B5. There are simple rules. You're just buying when your low is above it and you're up. Then you're buying some more when it's been 5 days, when it's been 10, 15 days, and so on. And when you break below it by more than the threshold of 0.2, you're selling. If you've been above it for a long period of time, you're selling a little bit more. Yes?
So you're saying, let's say you're in 4 or 5 stocks, and they're looking great, they're not giving you any issue, and you get that big S5 break there.
Yeah. You got to take some action. So. Mm-hmm. Yeah. You want to start playing defense, because when you're getting the buy signals, you want to play offense. You want to push things, because there's a time to push things and a time to just be on your hands, a time to be a little defensive and a lot defensive, depending on what our count is. And you'll see that when we go from fully invested to our first sell signal, it's just 10% of your account because we're pyramided in. So if you have 5, 6 stocks and you're 100% invested and we get a sell signal, you're going to want to react and sell something. And we'll talk about it at the end of the day, but many times if all your stocks are still acting well, you sell a little bit of each stock. So maybe you sell 2% of each stock. That raises enough capital. And you'll see it at the end of the day where it will make sense. Sometimes, like here, 2 weeks later, you're going to regret selling some, but we'll show you enough examples where it keeps going down that you're going to want to stay in line with what the count is. Because if you get too out of line for too long, that's when you're either going to be sitting on your hands during a bull market or you're going to be in getting killed. All right, so let's look on page 50. So we're out of the market over here because it's all grayed out. But you can see we have our break below our 21-day moving average, so that's our S5, and then trending below it, 1, 2, 3, 4, 5. So on that 5th day, our high is below it, but we're not down on the day, so we want to wait. The market could just be snapping back, so we don't want to sell there until we have more evidence that we really should. The next day it's up, so we're not using our S7, but then we get that weakness. So we say, you know what, it looks like it's not going to go back above the 21-day right now, so we have to sell a little bit. But we were already completely out of the market on this day, so that's why it's grayed out. Then you go forward a little bit. So we had day 1, 2, 3, 4, 5, 6, 7, 8, 9, 10th day. And so we're living below it, so you'd sell more. 11, 12, 13, 14, 15th day, you sell more. This S8 rule hardly ever is used. We have it in there as a just-in-case rule. So it's in case all the other sell signals didn't work and you're still in the market, that it will get you out. Then we go back above it. We don't act here because our low is not above it. We want a little bit more evidence. And here our low is clearly above it. We start acting. So day 1, there's day 5, day 10, 15, and so on. So all these over here we didn't need because we're already fully invested by this point with our other rules.
When you are out, I think if you have S8, you would be almost all out.
We were all out by this day over here.
So, and then you would be fine on B3, but
There would be a follow-through day in here before you can act. Yeah, and we'll talk about that as we put everything together. Just because you're back above the 21 day, you can't act until you have a follow-through day. And there's a whole way that we do that Charles will go over, and it'll make sense. So when you're within this segment, and especially through Charles's, just think of that, because then afterwards all the pieces will come together. So now up here, we've been above it for so long, clearly way more than 30 days. So when we break below it, we get both the S5 and the S6. Then we get all of these going on. So we're back above it here, but our low isn't above it. That's why we're waiting for B3. It helps us from getting whipped around in cases like this, because if we just said you closed above it, we would have bought here and then had to sell here. So it doesn't seem like a big deal, but when you add up a lot of buy and sell signals over time, anytime you can cut down on the back and forth, it helps your performance and the churning of your account. So we have our B3 right there, then our B4, and then our B5, and then the grayed out B5s. Is the 21 day making sense so far?